Hello and welcome to Finance JCL. Thank you very much for joining me today. Great to have you here. And we are on day 2 of 14 videos across 14 days. So it's a good challenge to celebrate 1 year birthday of the channel. So please join me for those. Now we're on Spotify today. So thanks to my man Luke, who has requested that. Not a company that I was overly familiar with financially previously, but one I'd certainly heard of. So it's quite an interesting one to review. And just before we start, usual disclaimer, I'm not a financial advisor, so don't take this as investment advice. Okay, we start with a quick overview of Spotify. So audio streaming services, and there's two versions. You've got your free version, which is supported by advertising, and then your premium version, which has some benefits and gets rid of commercial breaks. And we can see here at the end of last year, there's 1/3 monthly active users, so that's a huge number, and half of those appear to be premium subscribers, so it's a pretty good conversion rate. The company's also been around for 15 years. And we're just having a look at the competitors here. Now, you can see Spotify has several competitors, including Apple and Amazon. So you've got some of the really big beasts that are competing with them. And particularly Amazon's quite a worrying one, I suppose, in that you've got your Amazon Prime, which comes with multiple benefits. And there are several other medium to small size competitors. It's a very competitive landscape. Certainly, it's a very large industry, a market that has been growing over the last decade. Okay, so we are looking at the financial history on Morningstar. You can see here some very nice revenue growth in euros, do note, from 2 billion up to 8 billion now. So in the space of 6 years, their revenue has times 4, which is pretty good by any standard. Also importantly, that gross margin has increased from barely over 10% up to 25%. So that is a good sign. So as they're growing, they are improving that gross margin. But unfortunately, their operating income is still negative in every year. And therefore, the net income is negative as well. No dividend as you'd expect, because it's what you call a Peter Lynch fast grower, fast growing company. So they reinvest into the business. And there has been a little bit of dilution over that period of time as more shares have been issued, but not a huge amount. And then we look at the cash flow, which is what I'm often interested in. So there is free cash flow, and that looks like it's over 200 million euros. So that's the kind of top level. But let's have a look at the chance of failure and some of the other metrics. So I'd start off, I'd say, debt to equity, that is nice and low. Ideally, the current ratio would be a bit higher than that. And there's also a negative interest coverage figure as well, although nowhere near as bad as it used to be. And that growth rate in revenue has gone from 52% year on year, and it's been getting less and less and less. We're down at 16% based on the comparison of the last set of figures. Still a good growth rate, but it does seem to be slowing as they get bigger, which can often happen. So that's the top level view. And if we have a look at Yahoo, there's a few other metrics of interest here. So the analysts, it's reasonably well covered here, 23. And we're looking like revenue growth of 20% current year, 20% next year. So that's pretty good revenue growth. You can see in terms of earnings, high percentages there, but they're starting from a negligible base, so perhaps not reading too much into that. And again, it's good to have a look at the analyst recommendations. They certainly don't use that as a decision-making tool. Majority is hold. Quite a few are suggesting buys as well, with a price target of 320, and they're at 268 at the moment. So I think Wall Street is on this stock, and there's upside. And my view is, in the ideal circumstance, if I've got a portfolio in place, I want to try and find things that Wall Street hasn't found yet. And for me, that means a higher potential, high probability rather, of high returns. Because once Wall Street finds a stock, the interest level starts cranking up, the analyst recommendations come out, and the price starts to move a bit faster. So if you can get in before Wall Street has found it, for me, that's the ideal. And certainly in that sort of Peter Lynch fast grower category, that is what I would aim to do. So always like to have a look at the Simply Wall Street valuation just as a bit of a back pocket to have to hand, and it's suggesting it's pretty close to fair value at the moment, and that fair value is lower than the analyst target price we just saw. And we can look at this future growth here, suggesting 8 billion revenue going to 13 billion in at the end of 2023. So 3 years there to go from 8 to 13 billion. So that's a very nice rate of increase. And we're actually looking here at earnings of 190 million. So getting into the black on the earnings. Nothing to note on the insider trading. And we can see here that insiders own just over 8% of the company, so they do have some skin in the game there. Price chart to finish off with, and we can see here that during the virus situation, it bottomed out there in the recent times at 122, all run up all the way to 364, so that's times 3, and then went down to below 250. So it has dropped quite a bit recently, it's just starting to rebound. Just some news here, if you are considering this stock we've got on your watch list, it looks like second quarter financial results will be posted in around about a month's time. So if you're interested in this one, do put that date in your diary, because this could change the analysis depending on what's happened in the second quarter. But all in all, we've got a 50 billion company here. It's got some really big beast competitors. The forward P looks very high. On the other hand, there's hundreds of billions of users, got a good conversion rate to premium users, and the chance of failure looks low. So I'd say you're not likely, in my personal opinion, to lose 100% of your money. I don't see this company going bust. No, potentially it gets taken over by one of the big boys. Apple's got cash coming out its ears, sat on its balance sheet. They could easily buy this company if they wanted to, eliminate competition, gain 150 million premium users. I'd just like to finish off by having a crack at a discounted cash flow here. I mean, I think I've made my mind up in that for me, this isn't a buy. I can't see that there's going to be a massive return on this. The analysts have discovered it. I don't think this quite sits in my portfolio. That's not to say that you couldn't make money from it, and it's not to say that I'm right. I'm not saying don't buy it, but I'm just saying for me, it's not a buy. Now, I've pre-populated some of the information here, and we just need to pop in the growth rates. So we saw those 20% revenue growth rates. So I'm going to put in the free cash flow 20% the first few years, and I'm just going to start tapering that down as we go into the future. Let's just see where that leaves us. Oh, by the way, discount rate 10%, because I want at least 10% return. I'm going to part with my hard-earned money. So we're looking here at discounted cash flow. So that is the total amount of cash the business should generate, then revalued or discounted in today's money, because we're buying it today. That is the value there, 4.6 billion of discounted cash. And then if we have a final PE, I think that they could be trading at a PE perhaps of 30 fairly easily. PE of 30, a tech company that have higher PEs, that gives us a terminal value, or if we're sold the company after 10 years, of 15.8 billion. We add those two together, the intrinsic value of the company, in my estimation, is 20 billion, which is 107 per share. And so that's comfortably below the current price. We go back to the price chart. If we look back at 2020, for example, it was trading 120. But actually, it was trading around about what I think intrinsic value was then. Like 2019, there was a dip. 2018 there. So if one was following this stock, and you can see it's been quite exuberant, up and down, big up here, you could actually have bought the company if you were convinced you didn't want a margin of safety. If for a 10% return, you could have bought it at what I think the intrinsic value is. So it's a lesson in timing of purchase is very important. So what do you think? Is Spotify worth 50 billion? Is it a buy now? I would very much like to hear your comments below. Please let me know. What do you see their future as? Can you see them becoming profitable? Let's hear what we've got to say on that. So that is video 2 of 14 in 14 days. Just a final thing to flag up the Patreon site if you want access to the discounted cash flow calculator when I buy and sell positions, notifications of that, or to support the channel on its journey. Very much appreciate it. Right, nice one. Thanks for joining me today. Hopefully see you on the next one very, very soon as I continue this 14 videos across 14 days challenge. Have a good day.